Good afternoon, everybody. This is Ed Talisse for the CQF Institute and Chelsea Global Advisors. It's Monday, 23rd of February, 2015. I'm going to talk about two quick things today that have been on the attention and the radar screens of many market participants and commentators over the last couple of weeks or so. First, talk a little bit about the equity markets, where both the U.S. equity markets and indeed the developed markets in Europe really seem to have broken out on the upside. This is a result of firstly passing the earnings season in the U.S. without any major disappointments or blow-ups, although the earnings season was clearly mixed, but it was probably at the margin slightly better than expected. And secondly, in Europe, where the news, at least at the margin, seems to be slightly on the positive side, as this Greek situation seems to be at least kicked down the road for another couple of months. So we have another few months before the Greeks and the Germans go back to the negotiating table. So overall, the markets have responded very well and have seen new highs in the DAX and the S&P 500, and even the NASDAQ, surprisingly, which I guess had the most room to make up over the past 5 years, has now reached levels that we haven't seen before around 2007. So it was really big catch-ups in the markets last couple of weeks, and indeed over the last 5 years. That brings to attention what a lot of people are a little worried about, which is called this TMC ratio. TMC stands for total market capitalization, and that ratio is looked at versus GDP. So the idea is the numerator in this ratio is the total market capitalization, say, of U.S. stocks. That number today is around 22 billion, whereas total nominal GDP in the U.S. is around 18 billion. So if you think about it, the total market capitalization, 22 billion again, is greater than the total output of all goods and services of the U.S. economy in a particular year. Historically, this has been seen as a big warning sign for potential of underperformance in subsequent years. Buffett is a famous adherent to this ratio. Just wanted to spend a minute on it, where I think the ratio this time may not be such a good leading indicator for future underperformance. Most companies, if you look at their financial reports, will have single-year sales or revenues equivalent to GDP in the overall calculation that exceeds capital for a company, which in our instance is the numerator in the equation. So for example, Caterpillar is a good example. They have around 22 billion of revenues in any given year on about 12 billion of capital. Even technology companies like Apple have single year revenues that far exceed their capital base. So it's reasonable to assume that GDP, 1 year's GDP, should exceed overall market capitalization. However, what's going on in the U.S. is, particularly recently, the large banking sector led by the behemoths such as J.P. Morgan, Citibank, Bank of America have really needed to add huge amounts of capital to their balance sheets in order to comply with the rules and regulations that they face post 2008. So if you look at J.P. Morgan's balance sheet, they have, the last I look, around 212 billion of equity capital on the balance sheet, and off that capital they generate about 96 billion of revenues. So overall, I do like that indicator. However, I think you need to factor in the changes that have gone in the large banks that have really moved up the numerator in relation to the denominator quite aggressively. So something to keep your eye on: total market capitalization to U.S. GDP. It seems inflated right now. A lot of people are worried about it. However, I think it's too soon to worry about that particular indicator. Second thing I wanted to talk about, big week here in the U.S. With tomorrow, we have Ms. Yellen going in front of the U.S. Congress for her semi-annual report on the state of U.S. monetary policy. Personally, I have no idea what Ms. Yellen is going to say to the Congress people in the meeting on Tuesday and Wednesday. However, I think it's fair to say that most market participants were a little surprised by the dovish tone that came out of the minutes last week. Now, if I'm in Ms. Yellen's shoes, I'm trying to think of two things. There is the possibility to mistake by raising rates too early, say in June of 2015. And Ms. Yellen and her colleagues will be very well aware that both the ECB and the Central Bank of Sweden had made large policy mistakes over the past couple of years by prematurely raising rates. I think Ms. Yellen will also have been reminded by her predecessor, Ben Bernanke, who always talked about how Japan, on the cusp of a seeming recovery, raised rates in the late 1990s. I think it was 1997, only having to turn around and change policy very quickly thereafter. So that's one side of the debate. The other side of the debate is clearly if they leave rates too low for too long, Ms. Yellen and her colleagues are risking more financial bubbles that will only have to be unwound at some point in the future. And there's always a potential threat for inflation to come back and rear its ugly head, although all inflation indicators seem extremely modest at the moment. Right now, I believe that the best portfolio for most investors is overweight equity, simply because I think at this point it does not make sense to overweight bonds. I think if bond yields in the U.S. continue to move up, and they moved up aggressively in the last 3 weeks, I think that will change. But for now, I recommend overweighted equity positions. That's it for this week. Thank you very much. Again, please check out the website at cqfinstitute.com and my own website, chelseaglobaladvisors.com. Thank you.